Hello, Money Monday audience, and thank you for joining us today. I'm your host, Jill Thompson. Today, we are discussing part two of our life insurance segment. In part one, we learned that life insurance has a death benefit that can be used as a tool to leave an inheritance to future generations. Well, our experts are back. Venice Ewing and Armand McCarroll have returned to Money Mondays to share about the living benefits of life insurance. On our last episode, they shared that there are two primary types of life insurance, permanent and term. Well, there are living benefits to both. Venice and Armand, who have more than 23 years of combined experience in the life insurance industry, are going to tell us in this episode how to make the most of our life insurance policy by using its living benefits. To jumpstart the discussion, I want to share some things with you that I've read. According to an article entitled Bank on Yourself, written by the New York Times bestselling author Pamela Yellen, many permanent life insurance policies offer the advantages of exciting living benefits. These can include purchasing a home, investing in a business or commercial property, handling a financial emergency or supplemental income in retirement, or even paying for college without going into debt. Yellen wrote that the living benefits of life insurance allow you to bank on yourself. Let me repeat that, guys. Bank on yourself. That means you become your own bank. Now that's exciting. Let's welcome to the segment Armand and Venice. So many people are not aware of the living benefits of life insurance. Venice or Armand, I've just mentioned a few examples of living benefits. Can either of you expound on what are the different types of life insurance policies that allow people to take advantage of living benefits?
Yeah, we can. Venice, you want to talk about that for a minute?
Sure. So let's just speak of what living benefits is so people are aware again. Living benefits simply means that you have access to the accumulation or possibly
The death benefit.
the death benefit, a portion of the death benefit while you're alive. Most people assume that you cannot do anything with life insurance, it's just for death. Living benefits, in one case, for me and my family, just personally speaking, is the part about the chronic or terminal illness. Most people are not aware that there's help. If you are aware that, say some of us know that there are some things that are hereditary, I'm just going to call it like it is. And if you know that there has been several generations that have died or have come across the same illness, and it's most times it's one side, like either the men or the women. And so for my family, that was major. And so to know that I have access for things like rehabilitation, medications that may be just too costly, Jill, even for extra doctor visits, exams, just certain things that maybe the normal insurance doesn't cover. And so for me, that was a major difference.
Got it. And so what are these different policy types?
So you have, and let me just say this, Jill, it really depends on what company you purchase your insurance from. You got to make sure that you ask the right questions because every company doesn't offer living benefits. And so you can have living benefits in a term policy, and you can have living benefits in a permanent policy.
Okay.
And just like Venice said, all that means is you can access either the cash value or the death benefit prior to your death. And that's why they call it living benefits.
Okay. And can either of you talk about what's the difference between being a broker versus going directly to an insurance company?
Okay, so I like to say we're the CarMax of the financial services industry. So when you go to CarMax, what can you get? You can get a Mercedes, you can get a Cadillac, probably can even get a Bentley. I had to throw in that. I gotta have an orange Bentley. But anyway, but if you just go to a Ford dealership, all you're gonna get is a Ford. So a broker allows us to be able to shop for the consumer. So we can go to different companies, find out what our clients are looking for. go to different companies and offer the best of the best from those companies.
Got it. So if you have life insurance, would you say that you really be missing out on a lot of the living benefits because you're maybe not aware?
Listen, we don't ask a lot of questions when it comes to our life insurance. We just want to know how much it's going to cost, and if something happens, what's my death benefit? So it's really up to that agent, that broker, that professional to really ask the right questions to the client to find out what would be the right product. And just like Venice said, if dementia or something runs in your family, then we should be able to talk about living benefits. If heart problems or stroke or diabetes runs in your family, then we should be able to talk about those things. The problem is that a lot of companies don't offer those products, and we do.
Okay.
Yes.
And besides just the terminal illnesses or even chronic conditions that people may face due to different diseases, of course, we mentioned earlier that there are some living benefits that can have positive effects, where you could be planning for college for a child, or even purchasing your first home through having a life insurance policy. Can either of you elaborate on those particular living benefits? Because I think already when people think of life insurance, there's already this negative connotation to it. And so I think what we want to bring light to today is more of the positive side. So how can you talk a bit about how they can utilize and what are the different policy types specifically that they can take advantage of in order to start taking advantage of these living benefits?
So I'm gonna let Venice take, but I do want to say one thing. So I have a mentor, quite a few mentors, but I have a mentor that's a multimillionaire. He has a product that we talked about earlier, the IUL. Back in the early 2000s, when real estate was booming, he was using his insurance policy to flip property. So he would take money out of his insurance policy, buy the property, rehab it, send it back to the bank, refinance it, take the money that he refinanced it for, put it back in the insurance policy, and never paid a dime in taxes.
Wow.
So the wealthy use insurance a lot differently than the poor and middle class.
So let's talk about that.
Yes.
When you say that the wealthy use their life insurance a little bit different, what do they know that maybe we don't know?
The ways to get around how to knowing the importance of taxes, which is a major benefit. And that's where you save more of your money at home, Jill. You keep more of your money in your pocket. And so for the wealthy people, they're just looking for ways on how can I save more of my money and keep it. Not necessarily how can I grow it, because most wealthy people, that's not their concern. But they are concerned about how much can I keep at home.
Okay.
And so when you flip that to the middle class and poor people, we're worried about how fast can I get some more. So it's a different mindset.
Okay.
We're not worried about how can I keep it because there's not much to keep. And so you have to approach people from wherever they're at. There's a need for us, no matter who we're speaking to, because there's benefits to life insurance, especially when you're trying to build wealth and keep it at home. And so that's what I can tell my family and my community and my friends and my church. It's all about what you know, what you need, and what you need to do with it.
Okay.
For Armand's mentor as well as myself, it was real estate. For me, it's generational wealth for the grandkids and the great-grandkids that I may never meet. I have this thing of them wanting to know who I am, Jill, when I'm long gone.
Want your picture in the mantle?
I want great-grandma in everybody's house. Oil paintings, you know? And that comes when you leave that presence, even in your absence.
Question, how much life insurance should a person have?
So it really depends. It depends. So there are many different ways that professionals calculate. There's something called the dime method. There's something called 10 times your income. One of the things that we teach is there are 6 areas that all life insurance should cover. 6 areas. 1, funeral and burial expenses. Number 2, credit card debt that you want to pay off. Number 3, your mortgage. Number 4, college costs for your kids or grandkids. Number 5, income replacement. And number 6, your wishes. So when you add all those things up, that takes care of what your life insurance is supposed to cover.
Okay. And when we talk about permanent insurance, what type of policies fall underneath that category?
Well, I'm gonna answer that. I want to add to what our mom was just saying because that was critical. All of those 6 steps, sometimes, Jill, you have numbers in all 6, or you have some, should I say, areas where you have things already in place. So it's not like you're creating it now, today. Some people just don't know how to maneuver their monies and what's what and what's for what. So I don't want the audience to be fearful when they hear us say we help you create it. Don't get scared because sometimes you have monies, Armand, right? That's already there, and you just need someone to help you navigate to make that what it needs to be for you and your home. So I don't want people to think that they're starting today from scratch.
Okay.
Well, unfortunately, though, most people are starting
Some.
from scratch, but there's some that are starting, they already have things in place.
You bet.
Go ahead.
But when you talk about permanent insurance, there's quite a few when you list permanent, okay? Our company being brokers, and that's another benefit of being a broker, we're not limited. So when you speak of companies that can only service what they offer, sometimes you're limited. And that means for the client, they may not need just what you offer. They may need a little bit more. And if you can't offer that, that's why I find us different. Because when you can service no matter what the problem is, that's when you make a solution for the client. If you can only come halfway, then what does the client do to complete or satisfy their needs? And so when you think about permanent, you have life insurance, there's annuities, there's different type of riders, what we call, when you keep saying different types, well, there's only 2 types, and Armand has said it's temporary or permanent. What you're speaking of are the benefit riders. And so those are the additional parts to either of those, one of the 2, where you have the riders that's added. And it could be terminal illness. It could be a child rider. It could be a spouse additional rider. It could be a disability rider. It could be several. I know there are so many more that I haven't even touched on, but it depends on what the client needs.
Okay.
And so that's when we add the riders on to cover whatever special area that rider is to service.
Okay. I've often heard the term that what we don't know can hurt us, right?
Totally.
So how many people have life insurance but have the slightest of idea of how to maximize their policy?
Well, let's go back. How many people have life insurance and they have no clue on what they even have?
Yes.
I can't tell you the number of times I've sat down with people because, unfortunately, life insurance is that product that you buy and you throw it in a drawer, throw it in the safe deposit box, and you don't look at it again for 15 or 20 years. And so what I want your audience to know is review your policies every couple years just to make sure you have what you think you have. If you have a term policy, maybe that term has run out. Maybe you have a permanent policy, but you're not putting in enough to keep that policy going. There are newer policies out. If you bought your policy after the late 90s, you need to be upgraded because those policies didn't have a lot of living benefits that we're talking about. So it's important that you review what you have.
Okay.
Yes.
And so what are some newer types of policies that are available that maybe someone who didn't or maybe purchased a policy before the 90s does not have, or as far as that conversion that you're talking about?
Oh my God, conversion option. The option to be able to take a term policy and change it to a permanent with no medical.
Okay.
That's one. Living benefits, like we've been talking about, that's another. A lot of the older policies that came out in the 80s and the early 90s didn't have living benefits. Cash accumulation. You figure a typical whole life policy maybe will give you a 2 or 3% rate of return, where an IUL, although not guaranteed, you can get up to a much larger percentage.
Okay.
And so those are all the things that I always tell people, this is not the same insurance that your grandparents had. This is the upgraded version.
Okay.
So.
And I like to say that whole life. I just had a client yesterday. 20 years she's had this whole life policy. She's not 45 yet. the number's gonna just shock our mind, because I'm like, I had to keep it cool, like, okay, that's good. But I'm screaming, $4,000 accumulation.
In 20 years. Yeah.
Wow.
You see how you caught that? So if you're trying to build something, Jill, you're so far from having a down payment on a home if you're waiting on that to be your return. And so she understood the benefits of it being permanent, of her payment not changing, of her having it for a lifetime, but she did not understand what rate of return meant for her.
Wow.
It had cash accumulation, which was a question her agent probably asked, which was yes. But what is your accumulation intended for?
Okay.
That's a question that we ask, because it lets us know, what do you need? What rate of return? How soon? How quick?
Right.
When would you need this money to work for you?
Okay.
I can't assume when you're going to need to access your money.
Okay. And so you just brought up a term for someone who may be watching that maybe have never heard rate of return.
Yes.
So when you say rate of return, what exactly are you referencing? So there's a policy. I think sometimes some of our audience they best learn when you give an example.
Yes.
So let's say that Susan she's 20 or she's 25, and she now has purchased a $100,000 whole life policy. Does that policy have a cash value attached to it?
Yes. So let's use my client that I was speaking
Yes.
of,
Okay.
who's mid-40s,
Mhm.
early 40s, paying less than $100 a month, $100,000 face amount. 20 years, her accumulation is only $4,000. That's due to her interest. Your rate of return is simply your interest rate.
Okay.
And that's when we go back to the rule of 72. And I'm sure the audience can take out some paper. I'm going to give you a mathematical equation. No matter what your rate of return is, no matter what your face amount is, this number always works, okay? So you're going to take whatever your interest rate is, and you're going to simply divide it by the number 72. Don't ask me why. That's an equation that's been used for centuries. Most professionals use the same equation. We call it the rate of return, the rule of 72. You divide your interest by the number of 72, and that will tell you the number of years it will take for your investment to double. If you do that for your own monies, you'll get very close to what you're looking at and how many years it's going to take. So speaking of my client, her rate of return, which is her interest, was only about 3%.
Okay.
Inflation is 3%. She's not making a whole lot over the government. 3 divided into 72 is roughly what? 21?
6.
No. 3 into 72? You're talking about less than 20, about 24 years.
Mm-hmm.
She hasn't hit her first double yet. She's only 18 years into it.
Now, question for you. When we talk about cash accumulation or even generating a rate of return, is this additional cash that they're putting in aside from the premium on the policy? Or is it that there are certain policies where they take a portion of the premium and it's set aside into the cash value?
Okay, so let's talk about that. So that's a really good question.
Really good.
So, yeah, so, and that's the problem that most people have when they do permanent policies.
Okay.
They don't put enough in the policy. Okay, let me tell you what I'm talking
To even get
about.
to a cash value.
Absolutely.
Okay.
So in every insurance policy, you have something called a cost of insurance. They call it the COI. The COI is a number that's constantly going up because it's based on your age. Okay, so now my cost of insurance in my 20s is going to be very, very, very low versus when I get into my 70s.
Correct.
But if I don't accumulate enough money in my 20s, by the time I get in my 70s, that cost of insurance is so great that now it's sucking up my cash value. And so that's why a lot of people with whole life policies or underfunded policies, they're in their 70s, all of a sudden they get a letter from their insurance company saying, oh, you need to put in a little bit more money or this policy is going to lapse. That was the agent's problem. And so when we sit down with a client, just like Venice said, we sit down and say, okay, listen, I'll give you a good example. Had a client, 42 years old. She says, Armand, I want $500,000 by the time I'm 65. Okay. So I backdoored it. I said, okay. I went into the computer, put in $500,000, and I let the computer tell me what she would have to put in order to hit that $1 million at a certain rate of return. And she had to put in $1,400 a month. She didn't have 1,400, but she started with 7. And so she understands that she's going to put in 7 for a couple years, then she's going to kick it up to 1,400, and she's going to be real close to that $500,000. Okay. So you got to fund these policies properly. And going back to what you said is that's the overfunding. So a part of it is going to the cost of insurance, a part of it is going to administration, but the rest of it is going into a separate savings that grows over time.
Okay.
And the difference between the whole life and other policies is that the other policies have a higher rate of return, which makes, like Bernice said, makes your money grow faster based on the rule of 72.
That's good to know.
Oh, by the way, Albert Einstein brought that to the world.
Okay, well, having life insurance doesn't mean we know all the right things to do when it comes to choosing the best policy to meet our needs. So what should a person be looking for as far as when it comes to choosing the best policy for them?
Me and Bernice. Me and Bernice, right here.
The person, truly, Jill, I totally feel that way.
Okay.
I went through some challenges in my family the last years where I've had to step up since 2014. Immediate family, grandma, grandpa, uncles, aunts. And the agent is everything. They bring the light. They know what you don't know. They explain what you have no clue that's there. And so without that, you're looking at something, you're trying to figure this thing out, and you don't even know where to begin. And most times, like us in all 4 of our situations last summer, we didn't even have an agent to contact.
Yeah.
So you were around to sell me the product. Where are you when I need you to help service me with the product?
Now, question for you. When it comes to the client-agent relationship, I guess I'm assuming part of that pre-screening, when an agent is getting to know a client, would it be best that the client expose the fact that, hey, I may be 20 years old, I anticipate on purchasing my first home by the time I'm 30, I want to do some cash accumulation, or hey, maybe I'm a barber or a beautician, I'm planning for retirement, and I'm looking for a particular policy. Should there be a level of exposure that needs to take place? Because oftentimes I think sometimes when you get before the agent, most people just think death benefit, opposed to thinking, hey, I want to make this a 2-for-1 kind of special. I want there to be a death benefit aspect to it, but I also want to take advantage of this living benefit. So what should that dialogue be when actually conversing with the agent?
All right, so can I back up for a second?
Yeah.
So, I know this segment is on insurance, but if we take it a step back, both Bernice and I are financial professionals. Insurance is just one area that we help our clients.
Yes.
Right. One of the things that we do is something called a financial needs analysis. That's where we sit down with a client and we talk about their goals. When do you want to purchase a house? Are you going to have children? When do you want to retire? And then from that financial needs analysis, we go out into the marketplace and find the proper products that can help those clients achieve those goals.
Yeah.
Now, if life insurance is that product, then yes. And so let's say, for example, what most people have, they have all of their retirement in their 401k. They don't realize the tax implications that that's going to have when they get ready to retire. So a lot of times we bring that to light and say, listen, why don't you start a tax-free bucket so that when you retire, you got money coming that's taxed and you got money that's coming that's not taxed. That's where that life insurance can supplement retirement, for example.
Okay. And so let's talk about for a college student. So there's different topics I want to give you guys where you can kind of give your input. So let's say that there's a college student, right? Or there's a parent who's preparing for their child for college. What recommendations would you give them as to how to start the planning process so that maybe once that child gets to college, that they could potentially have some cash value to either pay for school or even to pay off all student loans?
Well, I'm going to say it gets really personal. Like Armand says, we have to know our clients. So before we even talk money, Jill, I'm asking what type of child were you? Where did you go to school? First, the question is, where would you like for your baby to go to school at? Is he going to just stay in a junior college? Is he just gonna go to the next state, which is Indiana for us, or Ohio is somewhere close?
Mm-hmm.
Or is your baby gonna be an overachiever because mom is an overachiever and he's gonna go to an Ivy League school? I'm thinking Howard like me and my dad. That's important.
Okay.
Tuition, Jill, right, is different between here in Washington and Brown or Harvard. And so that's the first question. Those questions come out, those answers, when we do the financial need analysis, like Armand says.
Mm-hmm.
So our clients understand that when we sit down with them, it's different. They no longer look at us as an insurance agent. We're asking questions that they've never been asked before from an agent.
Mm-hmm.
And more so, we're trying to be your financial help, not just in insurance. We're trying to create legacy with our clients. We're trying to create wealth. We're trying to show our clients the smartest way to do that. And insurance could be part of that, but it may not be the whole.
Okay. So how can the right policy help with their financing for college?
So the one area is money inside of a life insurance policy does not have to appear on a FAFSA. And I'm sure your audience, if they have kids that are getting ready to go to college, know what a FAFSA is. So that's one way. It can create, it could possibly get your child to have more benefits, more grants, more funds for college if you know where to place the money, and that's inside of a life insurance. So that's one area. The second area, just like anything else, people ask us all the time, when should you start saving for your kids' college? And I always say, as soon as they get a Social Security number.
Okay.
And you'd be surprised what $25, $50 a month can do over a 17 or 18-year period. So the one thing I would say, Jill, is to tell the audience, don't procrastinate on that stuff. Start putting away something. Pay yourself first.
Mm-hmm. What about, let's talk about the person who's planning for retirement.
Ooh, my favorite.
Can the right life insurance policy help in retirement?
Totally. Yeah.
Absolutely.
Elaborate.
In so many ways. Let's just talk about how some of the things it can help with. It can supplement your income. Some people look at Social Security, and our mom loves to tell people Social Security was never created to take care of anything totally off of Social Security. It's a supplement income. It's a little bit to do the little things that you may like and need. So for some other people, it could be income for a spouse that never works.
Mm-hmm.
You're the bread earner, the wage earner, but your wife has been a homemaker or a stay-at-home mom the entire 30 years.
Mm-hmm.
So for some, it's the replacement income when I used to be able to work overtime. I used to give that extra money to my wife. Then you have the ones that are thinking about their mortgages. They need something so where when I retire, I need the mortgage to wipe out as well. That takes a bulk of my working money away. If I'm gonna go on pension, I need to minimize my spending. So guess what? We can know that up front, or we know we need to maneuver some things and make that work. I love to say, put your monies to work so that we can alleviate that debt.
Okay.
And put a plan together for that.
You bet.
And how about saving for a home? Is it also possible for a person to purchase a home using their living benefit?
Well, the cash accumulation, if you're calling that a living benefit, absolutely, yes. You can, because that's your money. So, you could use your insurance policy like a bank. And you can do that to purchase a car, purchase a home, and you basically, much like your 401k, you're paying yourself back. So absolutely you can. But you got to have the right policy, Jill. You're not going to do that with a traditional whole life policy.
$4,000.
Yeah. I mean, think about that. $4,000 in 20 years. I did one yesterday. The girl is putting $150 a month. I mean, she's 36 years old, one child. I mean, she'll have over $250,000 if she continues to fund it properly. That's the type of accumulation that you can use going back to supplement retirement and to purchase a home.
You mentioned that you can't do it with a traditional whole life policy. Are you able to mention what are the other types of policies?
So you want me to do that?
Yeah, but I want to add something. I'll let Armand answer you, but I want to make clear with the audience when he speaks of overfunding. I know that they keep hearing that term and it's like, okay, what is an overfund? Because what they're thinking is, I have a premium, right? So where is overfunding? So your premium is what we consider what's necessary.
Mm-hmm.
This is the baseline figure that you must pay in order to keep your policy in effect.
I just want to throw one thing in. They call that the target.
Your target premium. And so with your target, that's just the minimum. You also have a number, which is your maximum month allowance or annual allowance. And people need to be aware of that. It may be just once a year, Jill, you're able to put another $2,000. You know, some money's is coming. You need to know that you can definitely place that money in insurance because like Armand is saying, you're just paying yourself. You're actually getting a higher interest on your money through yourself.
So you're telling me in that particular insurance policy, I can have a specific policy that's a permanent type of policy, of which you'll elaborate a bit more about what these different types of permanent policies are, because I'm sure people are like, well, you keep mentioning permanent policies, but we need you to tell us what is a permanent policy, right?
Yes.
What type is it? And then there's a maximum amount that I can be putting in towards the cash value? Is that what you're stating?
And it's voluntary.
And it's a minimum amount.
Yes.
So there's a minimum amount, and then there's also a maximum amount that I can be putting inside the policy.
Correct.
And that what creates the savings. You see how I'm trying to explain it so that it's not insurance. It's a savings. You're just saving your money somewhere where you can get more rate of return. If you're going to save in the bank, we're not knocking that, but what are you saving it for and how soon will you need it?
And what's your rate of return if you were to save in a bank?
That's when you know if it needs to be here, there, or somewhere else. It needs to work for you.
Okay. So back to that initial question.
So I guess the question, just to repeat the question, the different types of permanent policy.
Right.
Okay, so
with accumulation.
With the accumulation. So in the world of permanent insurance, you really have 4 types. Okay. At the top of that list, and I'm gonna go in the order of less interest, since Bernice talked about interest. The top of that list, the most expensive one that pays the least is whole life.
Okay.
But the reason why it's so expensive because that insurance company is guaranteeing that interest rate, whether it be 2 or 3%. Some people like that. The next one is universal life.
Okay.
Universal life, little better interest rate, lot cheaper because now the cash value offsets the death benefit, which helps the insurance company. Then number 3, indexed universal life, and then 4, variable universal life.
Okay.
And the only difference between indexed and variable is indexed, you cannot lose money. Variable, you can. It can go up or down.
Got it.
Okay.
Okay. And then also with term.
Yes.
Are there different types of term insurance?
Yes. You have return of premium term, you have regular term, you have term with living benefits, you got 5-year, 10-year, 20-year, 30-year term. So yes.
And does term ever have a cash value or cash accumulation component to it?
Okay, so I'm gonna have to answer that question cautiously.
Okay.
Typically, no. However, there are some companies out there that somehow or another, they've combined a term policy with an annuity, and they now call that some sort of cash value with the term.
Got it.
But traditionally, no.
Got it. Okay. So is there anything else you would like for our audience to know specifically about the living benefits of life insurance?
There is one thing I want to elaborate with the term, because most people do not understand that a term is going to end. That's why it's considered a term. It's temporary. So if you know your parents, and I'm speaking wholeheartedly about this because most people are walking around with expired term policies saying that they have coverage. That policy was given to them, Jill, from their parents 20 years ago, and they thought it was paid, and it was, but it expired already. They've never looked at it again. So now 10 years later, you believe and you have something, and you find out you haven't had insurance since 2009, 2010. And so the older you get, Jill, insurance is more costly.
Can I piggyback off that a little bit? Most people think that term policies end at the end of the term. Technically, they don't. People end them because the term means that's how long the premium stays level. So if I got a 20-year term and I bought that policy when I'm in my 40s, now I'm in my 60s and I'm in my 21st year, let's say it's a 20-year term, my premium is going from $100 a month to $800 a month. And guess what the regular person is going to do? Let it go.
And so I know that you mentioned about that there's whole life, and there are these different types of policies that are now available to those who may have purchased their policies a long time ago. What would you say, is there a conversion factor, or can they convert their policies to the newer types of policies?
So the answer is yes, Jill, but it really depends. If your health is still good, then yeah, we can make some changes. If your health is not good, then you might want to just keep what you have.
Wow.
But listen, I do want your audience to know that there's something called a 1035 exchange.
Okay.
And the 1035 exchange allows you, let's say you have a traditional whole life policy. I introduce you to this concept called the index, and you're like, man, my money can grow a lot faster in this index. What the 1035 allows you to do is take the money out of the whole life and transfer it to the new policy with no penalties or no taxes. And so, but it's important that your audience know that you have to have a company that offers all these products to be able to 1035 and exchange it too.
Understood.
And we do.
Understood.
And that's a good point to go back to the financial need analysis. That's why it's so critical when you sit down with a client firsthand, we ask those questions. We go through those 6 steps, because in one of those steps, we ask about existing coverage so that we can figure out if it's employment or something from mom. And we do offer a free review at that time. They can get up from their table, Jill, and take a few minutes and go find that policy, and we're going to review it right then and there.
That's good.
Yes. So most people don't even know that they need to be aware of what they have, and when they are getting more insurance, which is great, let the agent know what you have already. Sometimes we may be able to do something that's more of a benefit by just taking money from one pocket and putting it somewhere else.
That's good to know. So would you tell our audience that you guys offer free look reviews for policies?
Totally.
Yes.
Totally.
So just give us a call. Go grab your policies out the file cabinet in the back drawer under the bed, blow the dust off of it, and get it to us. We offer free reviews. Doesn't cost you anything. We'll let you know what you have. And then if you don't have what you think you have, we can certainly make recommendations.
How can our audience contact you?
So my name is Venice Ewing, and this is my Senior Director, Armand McCarroll. We are located in the Homewood area. Our number is 708-957-1800. Feel free to call and make an appointment. You can come into the office if you like. You're more than welcome. We definitely have an open door policy.
Awesome. And use keyword JBS or Money Mondays. Let them know where you came from.
Yes.
Is there anything else that you'd like our audience to know?
I just want to tell your audience that, I appreciate, Jill, you doing this segment. This is so beneficial. But listen, guys, take this information and utilize it. Don't procrastinate. Call us right now. Call JBS. Get this stuff taken care of, because we don't know when it's going to be too late.
Yes.
That's good to know. Well, thank you, Money Monday audience, for tuning in. We want to hear from you. Submit your questions in advance to moneymondays@jbs.edu. Again, that's moneymondays@jbs.edu. For those of you who would like more information about the Wealth Creation Center of the Joseph Business School and our Money Mondays segment, go to our website at www.jbs.edu. Don't forget to join us every first and third Monday of the month at noon to hear a new money topic on money management and wealth creation. Don't forget to hit the subscribe button. and subscribe to our JBS YouTube channel. I'm your host, Jill Thompson, and as always, I look forward to seeing you prosper.